Hey, welcome back. After what seemed like an impressive recovery, PayPal fell to the lowest point in about a decade due to tariffs and uncertainty around the economy. It even fell close to a buy for me, so let's look into them again. The growth hasn't been amazing due to the environment, but even if they fell, the margins and returns are still pretty significant. As a note, I think this is definitely more of a stable cash cow than a high growth company, but that doesn't mean there isn't potential. In fact, as you'll see later in the video, even if they just maintain like they are now, which might be challenging in this environment, I think there is still decent potential. They can make a very solid 5, 6, 7 billion in cash flows, which is definitely not bad for a 50-60 billion market cap. Even for them, that's the lowest ratio in about a decade, and looking into the operating cash flow a bit deeper, it's not even due to some unusual events or change in working capital. It's just a solid cash flow overall. That implies a very significant margin, well above some of the competition. Block, for example, makes about 1.5 billion on a not very different revenue, yet it's valued at like half of PayPal. But that's more of a growth stock that just became profitable and they focus on different things, so not a very fair comparison. I guess Adyen would be the real threat due to the very solid margins and growth rates, but that's a much more expensive company valued at almost the same market cap. Financially, they are in a very good position, with the current assets covering the total liabilities. We see that they don't really have that many long-term assets, although you don't have the value of PayPal itself on the balance sheet since they didn't buy it, so it's not in the goodwill. So we have 20 billion in equity on a 50-60 billion market cap, plus the difference in current value of the brands that they bought and PayPal itself. So overall a very good position, very manageable debt, and they can make a ton of money on such a market cap. Something to remember is that this company is tied to the economy, especially the US. When we saw the tariffs, they were among the most affected stocks, even if it obviously doesn't target them. That reaction came as a result of the effect of tariffs on the economy and consequently on them. Inflation, uncertainty, lower consumer spending, maybe even a recession, that's the worst environment for PayPal. On the bright side, this has potential to grow significantly during a recovery. So maybe some deal around the tariffs, rate cuts, or if not eventually a new president could be enough to see economic activity and them do very well. I mentioned the president because in the US in particular, you have to remember the power that the leader has. In countries where we've had and gotten rid of tyrants that had absolute power, you'll see that the president or whatever the leader is called doesn't have that much power, and passing something like Trump's tariffs would be very difficult. Think about Eastern Europe, Spain, Italy, or the perfect example, Germany. In contrast, you have France, the US, kind of the UK, Australia and so on, for which the leader still has relative power. In other countries, it's more like the top diplomat than someone with actual power. So this is a very specific risk for the US that actually manifested, and now we see the results. No country is absolutely risk-free, keep that in mind. Now, a common trend in pretty much any PayPal video that I've made before are the quality issues and various bugs. I use PayPal monthly now and I can't really complain, but all I do is receive some money and take it out the next second, so I can't really call myself a user. The absolutely basic stuff is okay, but yes, PayPal is known to have not the best platform, and the fact that they managed to still make so much money is really impressive with so much competition. And they are also known for having higher fees. I guess its main advantage is the fact that it's much more popular and widely accepted, but that's not a solid long-term advantage. Eventually, as the competition catches up, they'll have to cut some of the fees, and if you think about it, having higher fees and margins now is probably the real advantage. As smaller companies with lower fees eventually take over a significant market share, they can just announce cutting the fees and win from the volume, or preferably even before. They don't need to do it now when they still dominate the market. Same about the bugs, they have and make more than enough to solve anything or just do a complete platform rework, but they seem to wait until it's really needed. I think they go for a if it makes money, why change it approach. It's been correct so far, but it doesn't mean it's the right long-term approach. We'll have to wait and see. What's also impressive about them is the huge buyback yield. 5, 6, 7 billion on a 50 to 60 billion market cap now is an amazing yield and among the highest on the planet in big tech. And when we look at the stock-based compensation, it's like a bit over $1 billion, so they don't even put back that much into the market. Eventually, if they keep it up and the business doesn't disappoint, there won't be enough selling pressure, and this kind of yield combined with some good reports can really push up the stock quite a lot. Remember that they went to like 90 from 60 in not even half a year a few months ago. And if the stock recovers, they can switch to dividends and we could still see even some 10% yields from the current price. So if things go okay and they continue on this path, this has potential to be very rewarding. I mentioned before that a potential opportunity or more of a safety net for PayPal in this market would be something like Amazon, Apple or Google buying them using the stock. Even now the dilution would be meaningless and they could integrate it in their Google or Apple Pay or Amazon.com and potentially expand it significantly. And Amazon, for example, is actively doing this kind of stuff. They keep changing the management and even got a new CEO like a year ago, and we see an overall good direction. We see the launch of PayPal Open, Fastlane, focusing on Venmo, partnerships and so on. I see that he planned to focus on more profitable growth, which was an issue for PayPal before, do some cost savings and have an overall leaner and more efficient company. And again, I think there is a lot of potential in South America and SEA especially, so even a company like this can grow quite a lot, although the competition remains very tough. Now let's see a valuation. In a bad scenario, let's say the environment and competition get even worse and they get to around 4 billion per year. Say the ratio is at 8, which is very low for this kind of company and would show a lot of disappointment, especially in the US, and that's a 32 billion market cap. That's a price of 32.35, so a very significant drop. However, this is at the current number of shares. If this happens over half a decade and they repurchase half of the current shares in the meantime, that's basically double the price. But keep in mind that the buybacks aren't guaranteed and some new CEO or activist investor can always come and say we need to invest so we have to stop them or whatever, so don't think this is a guaranteed safety net. In a second scenario, let's assume that they stabilize at 6 billion due to the higher competition offsetting the environment. Say the ratio is at 12, which is low even for them but would show some worries about the market, and that's a 72 billion market cap. That's a price of 72.78, so a bit of a profit plus the potential from buybacks. Potentially, this could be over 140 in half a decade to get us to that market cap, so there is potential. I know it sounds like a lot, but keep in mind that this is among the highest buyback yields in the market globally. 20 billion already authorized, 6 billion expected this year, it can add up quickly. In a better scenario, let's say that thanks to a recovery in the market and some global expansion, they get to 9 billion per year, which isn't that much from 6 to 7 that they expect this year. Put the ratio at 20, which is, I'd say, normal for this kind of company in such an environment, and that's a 180 billion market cap. That's a price of 181.95, but even more than double with the buybacks. Theoretically, that's even more than a 6x, which is amazing even in a decade. The thing is, if they keep doing this kind of buybacks and the company is doing okay, it's very tough to see the price not improve, and the efficiency of buybacks diminishes as the price goes up. There is only so much selling supply. By the way, if you want to support the channel and see when I buy anything or even get a custom stock analysis or even 2 each month, check out the Patreon link below. And now you also get all the other analyses ever requested by other members on top. So overall a good and still powerful business that's getting to some very interesting prices once again. By the time I post this, I may have bought a bit already if they fell enough, but you'll see on the screen. Again, in a recovery, this kind of company should do very well, but who knows when that comes. But long term, I think they have room to improve and develop, especially if they focus on international markets and maybe do some acquisitions. Again, with the buybacks and potential dividends plus potential for a recovery and international expansion, I think the risk reward is quite attractive for me. I've always called this a strong buy in a downside because of the consequent upside potential, and we might be getting into that territory. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching, and I'll see you next time.